my Social Security benefits be taxed? And understanding the taxation of Social Security benefits. Not only is it important to understand the components of the benefits so you can maximize them, it is equally important to determine how they're taxed, because ultimately understanding this piece helps you understand how much of your Social Security income you get to spend. Quite frankly, it begins to help you understand how much of your overall retirement income you get to spend, since you only can spend the dollars you keep. And you need to be familiar with the rules about when and how much you pay in taxes on your Social Security benefits and your other retirement income. So let's simplify this piece so we can help you understand and determine how retirement income is taxed. Ready? Here we go. Question I get a lot: will my Social Security benefits be taxed? Well, here's the bad news. Social Security is taxable. Here's a little bit more clearer definition. Whether it gets taxed and how much of it gets taxed, well, that depends, right? You have to understand this thing called provisional income. Provisional income is another one of those definitions you're going to want to be familiar with. Provisional income is a calculation that's used to determine whether you'll pay taxes and how much of your Social Security will become taxable. Your provisional income, here's how it's calculated. And you just have to know this. This is something that happens off the 1040, off your tax form, to determine how much of your Social Security gets pulled back onto the tax form. But essentially, it's a calculation that takes half of your Social Security benefits, then it adds back in any type of adjusted gross income. So that could be wages, it could be pensions, it could be IRA distributions, it could be dividends, interest, capital gains. And then it actually brings back, interestingly enough, if you have any of this, brings back some typically non-taxable muni bond interest just back into this equation. And that gives us a number, right? And that number is something that the government uses to determine, are your Social Security benefits taxable? And obviously, and then how much? So let's take a look at the thresholds here. You have to understand these threshold things. Once you understand that there's a calculation called provisional income, then you have to understand these thresholds. Thresholds determine if 50 to 85% of your benefit would become taxable. Now, as I go through this, and I'll walk through them in a second, that means no matter what, 15% of your Social Security benefits are not taxable. At least currently, that's the case. So that's good. But it is important to know whether your Social Security benefits are taxable and to what extent. So there's these things called thresholds, and it depends on whether you're a single filer or you're married filing jointly. And of course, there's with some of the other filing situations, there's other ways to look at this. But to simplify it, if you're a single filer and that provisional income calculation was below a $25,000 threshold, none of your Social Security benefits are taxable. Okay. If you were a single filer and you pierce above that $25,000 threshold, 50% of your benefits become taxable, right? So half of that Social Security income now gets pulled onto the tax tables because you pierce through this threshold. And then you'll notice that the next threshold up is $34,000. So if you earn just a couple more grand, or a couple more grand is pulled in that form of the equation, up to 85% of your Social Security benefit becomes taxable, right? You see the thresholds are a little bit different for a married filing jointly couple, a couple that's married filing jointly. If the threshold is, if the provisional income is under 32 grand, Social Security remains not taxed. If you pierce above 32, half of Social Security becomes taxable. And then of course, if you pierce above $44,000 of that provisional income, 85% of your benefit becomes taxable income. There's an interesting side note here too, ladies and gentlemen. These thresholds, even though other things have adjusted over time, we've gotten cost of living adjustments, the earnings test numbers have gone up over time. Uncle Sam's been pulling more and more, the amount of income that he charges payroll taxes on has increased. And we talked about some of those changes earlier, how they're starting to tax more payroll for Social Security. These numbers right here, these thresholds, they haven't changed since the early 90s. So in other words, as income has increased, including Social Security income, once it's plugged into that provisional income calculation, more and more of these benefits have been brought back into the taxable environment because these thresholds have stayed put as other income has increased around. Just a little side note about that. And it's important to know these because once you know these, I'm going to show you in a few seconds an example of how how much gets taxed. But once you know these, there's an opportunity for you to make some decisions around it to create more tax efficient income and possibly get Social Security off the taxability radar. So here's an example. Let's say that you have a husband and a wife, $3,000 a month total Social Security income. So $2,000 coming in on his checks, $1,000 coming in for her. The question we have is how much is taxable? Well, it depends. It depends on this provisional income thing, right? So if it's just Social Security coming in, and that's $36,000 a year, with the provisional income calculation, which we're going to look at in the middle here, right? You take half of Social Security, comes into that equation. If it's a husband and wife, the lower end threshold is 32 grand. So since that provisional income is not above 32 grand, there's none of the Social Security is taxable, and there's no dollars of the Social Security taxable. So 36 grand is not taxed at all, not considered taxable income. That's how that works, right? Low threshold, but I just want you to see that. Now, it changes a little bit when, let's just say that the husband and wife are taking money out of their IRAs because that's what they wanted to do. They want to travel. They want to spend money on the grandkids. They want to do whatever they want to do. You have half of the Social Security benefit gets pulled into the equation. Then IRA withdrawals, traditional IRA and traditional 401k withdrawals are completely taxable. So that gets pulled on into that equation. So you add these two numbers up, it's 38 grand. Obviously that's over $32,000, but it's not above that next threshold. That means half of Social Security would become taxable, and half of this number, 36, is now taxable income to go into the equation. That would obviously be taxed on top of this and anything else, you know? And then lastly, if they're lucky enough to have a pension, this is just an example I see sometimes. Sometimes they're lucky enough to have a pension. So let's just see that, 36 grand that they have coming in Social Security income, half of that goes into the equation. Let's say they're pulling money out of their retirement accounts, and then they're lucky enough to have $1,000 a month pension, right? That all gets added up in that provisional income equation. That number, the sum of that is 50 grand. That's obviously above the higher threshold. That means 85% of their Social Security would be pulled in as taxable income on their tax documents, 1040. And then we see $30,600 of the 36 grand now becomes taxable. So, is your Social Security going to be taxed? Well, when 85% of your Social Security becomes taxable, essentially what's happening is you're being double taxed. Why? Because when you were working, you paid taxes for your half of your Social Security benefit, and your employer paid the other half. Back in the 80s, the IRS was given permission to potentially tax the half that was coming from the employer, since that was paid on your behalf. So you paid your half, the employer paid the other half. Back in the 80s, they said, okay, you can start taxing up to 50% of the Social Security benefits. But in 1993, legislation increased the portion of benefits potentially taxable to 85%. That essentially created a double tax. And now you're being exposed to paying tax on the portion of benefits that you're already taxed on to create from your paycheck and payroll contributions. But you can avoid payroll. You can avoid that double taxation. You can avoid double taxation and take control of your retirement income and your income sources. One way is to diversify. Consider your retirement investment account allocations. You understand diversification, but let me just expand that concept of diversification. So I'm not looking at it just from a stock and bond lens. You should also be looking at it from a how is my money going to be taxed lens. And this is one area where I often say, we need more than a pie chart here. We need a plan. So I'll introduce a 3-bucket concept. And in this 3-bucket approach for controlling taxation and controlling your income, I'll introduce on the left, we'll call it bucket number 1. This will be our taxable bucket. This is, dollars that you usually use for current income needs, and it can be filled with pensions, Social Security, private annuity payments. It can be filled with non-qualified investments, things that Uncle Sam taxes each and every year or each and every time it gets paid to you. But just because it's in this bucket, especially in light of what I'm about to say with the other 2 buckets, doesn't necessarily make it bad. Some items here get very favorable tax treatment, but they're different from the items in the other 2 buckets, because on the middle on the right, we have our tax deferred and our tax free buckets. So essentially bucket 2 and bucket 3. In the middle, the tax deferred bucket, that would be our money when it's not taxed going in, it's not taxed as it builds, but it's fully taxable as it comes out. And even if you don't want it to come out of that second bucket there, there's a time when Uncle Sam starts to make you and require that you take it out. That's called those RMDs, or required distributions. Why does he do that? Because he wants to get his piece. I tend to find that too much money in this second bucket creates an income tax issue that's not addressed with your wills and trusts, makes more of your Social Security taxable, and it causes you to pay way more to Uncle Sam than you typically would have to. Bucket 3 is where this comes in to play here, because the bucket 3 is our tax-free bucket. It's where we get Roth IRAs. It's where we get life insurance. It's where we get charitable bequests. And you'll notice these two buckets have spigots on them, because for the most part, outside of RMDs here in the second bucket, for the most part, we have the ability to turn the spigot on or turn the spigot off. And the problem that I see is all too often, folks have been walked down the road of completely filling bucket number 2 by following the defer advice without ever considering, how the heck do I get this money out? And with Congress eliminating the multi-generational IRAs that they did back in 2020 last year, too much money in bucket number 2 and not enough money in buckets number 1 and 3, it can be a tax nightmare. It can be a tax nightmare for you. It can be a tax nightmare for your family, for the heirs. Or if you want to look at it from a slightly different perspective, you can look at it as a windfall for Uncle Sam. Because if you look at it from his side, he's like, okay, I'm going to get to tax that at future tax rates, which are probably going to be higher than they are today. Our process helps clients better determine which assets and income streams should go in which one of these buckets, so you can better control where your income comes from in the future. And that's where, with sound planning, that's an outcome of our 3-step review, you can determine which assets and income streams should be positioned where, so you can take control and create tax efficient income, create tax efficient paychecks all through retirement, so you can spend more, possibly even pull your Social Security down into that lower threshold of taxation. But going back to what I see all too often, the typical defer taxes, that causes the buckets to be way out of proportion. And reflecting on bucket number 2, here's an important question. Excuse me. Here's a very important tax question. How much of your retirement accounts are yours? And I don't just mean what's the account value. I mean, how much is in there and how much is yours? Seriously, how much is Uncle Sam's? Is Uncle Sam's piece 12%? Is Uncle Sam's piece 24%? Is Uncle Sam's piece 32% or more? So apply that to your accounts. Does that mean $200,000, $400,000 or more belongs to Uncle Sam? I mean, you already saw how Uncle Sam considers more and more of your Social Security as taxable, so he can take it back. Well, that's what he's going to do. He's going to do the same thing with your traditional IRAs and 401ks. And I stand by the opinion he's going to increase his tax rates as time goes by. I mean, we're in one of the lowest tax environments in history, while our government spends enormous amounts of money. All you have to do is look back at history as to what happened to tax rates after massive spending by Uncle Sam. I mean, tax rates are poised to go up. So Uncle Sam's piece can be a lot larger than you're aware of, and quite frankly, a lot larger than you think. So would you agree that it would be critical to know how much of your retirement accounts are yours and how much are spendable? Would you agree that 3-bucket planning would be something critical to know and understand? And have you been, like I mentioned in the stories, have you been using one big bucket for all your assets and income streams? Can you see how this could cost you money if you missed it? Wouldn't you agree that having this discussion in the past would have been beneficial? So what's my point? What's the point that I'm making here? The point is that most people don't have a process, a checklist, or an outline to follow. They don't know what questions to ask to identify all the critical facts in order to make a sound financial decision that's in their best interest. Listen, you've worked hard and you've saved so hard to build up your accounts. Now you just have to figure out how to keep them. If you didn't know about this tax angle or even about the 3-bucket planning concepts before making past financial decisions, you made those decisions without all the critical facts necessary to make a sound financial decision in your best interest. But it's not uncommon. Most of the other advisors that focus on defer as you build up that second bucket and you build up your 401k and your IRA accounts. They don't even give you the slightest insight into what your RMDs look like or what Uncle Sam's cut might be in the future. And you've probably heard me say, most folks nearing retirement, they don't need a pie chart, they need a plan. And that's what a process provides. That's one of the key takeaway points I'm looking for to share with you. That's what a process provides.